Hello and welcome to Signal or Noise and our first global markets show for 2024. And it is really timely that we are doing this particular episode because just think of what's happened in the last few weeks. Central banks in the West are starting to splinter on when they will be able to cut rates. But meanwhile, the S&P 500, Bitcoin and spot gold all hit all-time highs within the last month. And the CNN Fear and Greed Index has now been screening greed for 4 straight months. So is this a sign of a confused market? And come to think of it, are there any reasons that this everything rally will be stopped? Joining me are a team of people who belong to organizations that manage something in the neighborhood of $3.5 trillion in assets under management. Of course, our resident economist, Mousina of AMP, is one of them. And joining us this month are Lukasz de Pourbaix of Fidelity International and Tom Nash of UBS Asset Management. A warm welcome to you all. Thank you for joining me.
Thank you.
First up, let's deal with the slew of central bank rate decisions we've had that shows some decidedly different paths. In just a few weeks, the number of cuts priced into US rates markets has collapsed from 6 to 3. And you can see the change between upcoming meetings and rate cut probabilities in this chart from Bianco Research. But it's not just the US. The Australian rates curve now has just one cut priced in before the end of 2024. After the RBA's most recent meeting, rates traders believe it's most likely around September. And then, of course, there is the Bank of Japan, which had the world's last negative rate policy, but finally lifting interest rates recently for the first time since 2007. And the end of negative rates and deflation caused Bank of America strategists to raise their end-of-year target for the Nikkei 225 and turn more bullish on Japanese value stocks, which may benefit from rising earnings and rates. So, panel, does the splintering in central bank messaging matter? And Deanna, I'll go to you first on this one. Signal or noise?
Signal. I mean, the central bank is just responding to what's going on in their own domestic setting. So obviously, the situation in Japan is quite different from what's going on in the US or Australia. But I think if you look at the major central banks, they are all mostly on the side of we are going to start cutting at some stage this year, but we're probably not there quite yet. There's no need for a rate cut at this moment because growth in general is still holding up pretty well.
Deanna, let me stay with you and we'll look at this very colourful chart you brought along. This is recent moves from central banks, but I'm curious, what are you trying to show here with this chart you brought along?
So the reason that I wanted to bring along this chart was because I think it shows that central banks don't necessarily have to follow whatever the Fed does. We have this assumption, especially in Australia, that the RBA will follow whatever the Fed does. Now, that's not necessarily true. That black line there is the Fed funds rate, but you can see that at the peaks and troughs when the most central banks are cutting or hiking interest rates, the Fed hasn't necessarily been the leading indicator of that. That black line has often moved after you see the peaks in that blue shadow or the peach shadow, I guess. So it's just a signal that we don't necessarily have to follow whatever the Fed does. You can see actually that we've seen some central banks already start to cut interest rates. Those peach bars have started to increase, but those are mainly in the emerging world. So the Fed hasn't necessarily led this cycle by being the first potentially to cut interest rates, although I think that the ECB will probably go before the Fed. We've already seen the start of rate cuts in some parts of the world.
More peach and blue in economics charts. Big fan of that chart. Thank you very much, Deanna. Lukasz, I'll turn this same question to you now. What do you think, signal or noise?
I think it's a bit of noise, but more from the perspective that obviously different economies are at different points in the cycle. So to Deanna's point, Japan's a good example. Obviously they've had CPI go up, but conversely, other parts of the market, I mean, China's a great example where obviously there's the other end of the spectrum, right?
Well, talking of the US and, the US maybe once leading a cycle that they don't lead anymore. Lukasz, let me stay with you. We'll bring up this chart you brought along around US job market tightness. I'm really curious why you brought this chart along and what does that say to you about how you're investing?
Look, the main reason, sort of referencing that chart is it's what a lot of the central banks are really focused on, whether it's the US, whether it's the RBA, because as we've seen, obviously, rate hikes, employment's remained stubbornly higher than expected, I guess. So if you look at non-farm payrolls, for example, in the States, they were sort of higher than expectations. Similarly, in Australia, we've had similar data. So I think it's an important signal in terms of giving the central bank some confidence in terms of whether they cut rates or not.
All right, fascinating. Thank you for bringing that along. Tom, I'll turn this question to you now. Signal or noise?
Yeah, it's noise for me. So 2-1 for noise. I think the key conviction that we've got and the message that we're sending out is that the global rate cycle has turned. and we're going to see easier policy. So I think Japan is almost the exception that proves that rule. Where's that coming from? It's really a big picture thematic that we're going from an environment where we've got high inflation globally, strong growth that requires more restrictive policy settings, to one where we're transitioning towards lower inflation, slower growth, and that means that policy settings have got to be eased, and that's pretty much true across all the major global economies that we look at. And as I said, Japan is a minor exception. We can have the debate about how fast, what kind of who's going to go first, who's going to go last, which I'm sure we'll probably get onto. But I think a lot of what we're hearing at the moment is noise, and that's typical at the turn of the cycle, and we need to kind of zoom out a little bit from that.
Well, let's do the little bit of that, right? The who's going first, the who's going last, who's in the middle. And I guess speaking of the RBA, I thought it was BlackRock's Craig Vardy who may have put some of the market's feelings about the RBA into words best. This was a quote from a recent media roundtable that he was presenting at. He said, quote, "The RBA was slow to hike, and it feels like they will be slow to ease as well, even if the Fed goes in June," which I guess again speaks to your point, Deanna, about how different economies are doing their own things. We put this same sentiment actually to Seamus McElrain, the head of global rates at UBS Asset Management, and he offered us this. "I think that the descent picture is clearest in the US and in the Eurozone, and there are some economies where it's a bit less clear, and Australia is one of them." So, panel, and Tom, I'll start with you on this one. I mean, would you agree with that sentiment? Do you think the RBA will be slower, or even the slowest of all those major central banks to cut? And what does that mean for investors?
Yeah, I think there is some signal there. When I think about the question of who's going to cut first and who's going to cut last, it reminds me of a kind of cycling race, right? So I don't know, Hans, if you watch the Tour de France at all, but the cyclists tend to gather in a kind of peloton, right? And no one really wants to stick their neck out and go first. They're all bunched up, if you like. And to some extent, I think that's what's happening right now. I did bring a chart along actually that kind of
let's talk about this chart now. Actually, we're talking about implied central bank rate paths. Go for it.
Yeah. So on the right hand side of that chart, you can see where the market's price for each of these major central banks in terms of when they're going to cut first. And to my point, at the front of the peloton, you've kind of got the likes of the ECB, the Bank of England, the US Federal Reserve, and the Bank of Canada as well. And then a little bit behind, you've got the RBNZ and the RBA. It's only really the Bank of Japan that's doing its own thing. To stretch the analogy further, they're off riding their own race.
We've never spoken so much about Japan.
Yeah, exactly. So there is a bit of divergence there, and I think you're right that the RBA is at the back of the pack. I think the big question is, what does that mean in terms of investment implications, right? And there's one thing that the markets that we want to own, where we want to own interest rate risk, where we like the bond market, are those that we think the cut should be coming sooner rather than later, and where the easing cycle is potentially quite significant and could be larger than what's priced in the market, which you can see on the left-hand side of the chart there.
All right, thank you for bringing that along. That was really interesting. Deanna, I'll pose that question to you now. I mean, I know AMP has 3 rate cuts priced in for this year as a base case, but this idea of the RBA being slower or even slowest to cut, what do you make of that?
Well, historically, it has been one of the slowest to move, either up or down. So I guess that if you just look at historically, then yes, you could say that in this cycle that the same thing will happen. But I think it is different this cycle, because even though they may seem reluctant to cut right now, I think they may be forced to cut because the growth environment, in my eyes, is going to deteriorate in the next few months at a time when inflation's also slowing, and the February inflation data certainly points to a slower path of inflation than the RBA has been forecasting, and it gives them potentially the room to start cutting probably around the same time as the Fed. I don't think that there's it's not necessary for the RBA to start cutting after the Fed at all. If the domestic growth environment warrants them to cut beforehand, then so be it. Yeah, no, absolutely. Lucas, what do you make of this premise of the RBA being slow?
Yeah, I mean, I think it has been slow in the past, but I think the interesting one is, I mean, I think people are waiting to a degree in terms of what the Fed does as well. Not as a prompt, but I think they will be looking to see what the Fed does. I mean, interestingly, if you look at Australia, I mean, yes, we were late to hike. Arguably, the inflationary environment wasn't as strong as, say, the States. That's true. But conversely, if you think about it, the impact of rate hikes, you could argue, have been far more impactful within Australia because of our high exposure to variable interest rates, whether it's through mortgages and other debts. So there's this sort of, I guess, it's a fine balancing act at the moment in terms of rate hikes. But I think the RBA will probably follow the likes of the Fed.
Okay, interesting. Thank you for that. So one of the reasons that markets have been able to rally so much has been this notable and actually quite lasting change in sentiment. A range of sentiment indicators, including the CNN Fear and Greed Index, continues to remain at elevated levels. You can see a chart of that on your screen now. It's been showing a greed reading, which is 55 points and over, since the middle of November 2023, and it doesn't really show any signs of declining. And you're seeing something similar as well in the Goldman Sachs Financial Conditions Index, where rises have far outpaced the macro narrative. So, Lucas, I'll turn to you for this one to start. Is this loosening in financial sentiment the kind of signal investors need to be taking seriously? Signal or noise?
I think it is a signal. I mean, from the perspective that the market can get over positive and over negative to both sides. So I think it's always interesting when the market is, consensus is basically that the market's going to go up. It's always interesting to have a look in those environments as to the sustainability of that. Conversely, on the flip side, when the market thinks, well, everything's doom and gloom, well, actually it might be an interesting time to have a look at that market as well. So I think it's a bit of a signal. Okay, interesting. Tom, what do you make of it, signal or noise?
I'm in the noise camp. I do have sympathy with what Lucas is saying there. I come from it from a slightly different angle.
Sure.
In that, I asked the question, the fact that stocks are going so high, the fact that Bitcoin is rising, does that affect what I think about the bond market? And the answer is probably no. What central banks are telling you at the moment is that they can still ease monetary policy even though financial conditions are loosening. And I think that makes sense, right? If you think about how monetary policy works, it does work through the financial channel. So it would be strange if they were doing the opposite and trying to chase their tail and tamp down financial conditions. I guess the only side where I think perhaps this could turn into signal is if you start to get these really large wealth effects, right? So if you're confident that your asset price is going up, your stock portfolio is doing well, or your house value is going up, then does that make you want to go out and spend? And it has a real world economic impact. I think in Australia the answer to that is no at the moment. You could argue maybe some of that is happening in the US, but in Australia at the moment I think the negative income effect, the squeeze in disposable incomes through inflation, through mortgages, and through taxation is stronger than any wealth effect at the moment. So for me it's noise.
Yeah, absolutely. Deanna, where do you fall on this, signal or noise?
I'm going to say noise as well. Sentiment indicators have been at very elevated levels for some time now, and the share market in the US and in Eurozone has been rallying alongside that. So it can sometimes be a sign, I guess, to what Lucas was saying, that conditions are overbought, and it's certainly, I guess, one of the, if you were listing a list of reasons as to why shares might go down, you would include the over-exuberance in the market as one of those. But at this current point in time, with growth remaining pretty good around the world, the chance of rate cuts still priced in, I think it's a bit of a noise.
Yeah, okay, fair enough. For our third topic, let's turn to some comments that were made by JP Morgan CEO and Chairman Jamie Dimon, who said this at the Australian Financial Review Summit recently. It's a quote that made headlines all around the world. Quote, "The worst case of recession would be stagflation. That's almost off the table if you look at people's projections, but I wouldn't take it off the table yet." So, panel, and Tom, we're going to start with you for the third round. Would you agree with Jamie Dimon's comments, or is he being too pessimistic?
There's some signal in that.
Okay.
And that's not just because I'm a gloomy fixed income investor. Although
I didn't say that.
Maybe that does play into it a little bit. But it's really about the distribution of risks.
Sure.
So what we see right now is a really strong consensus that we're going to have this kind of Goldilocks environment, right? In terms of the interest rate space, what that means is that pretty much everyone, all economists are saying that the RBA is going to ease back interest rates, and you're going to cut to somewhere called equilibrium, which is around 3%. You can kind of throw a net over all the forecasts out there. I think what we need to ask ourselves is, how often do these views ever really come to fruition? It all sounds a little bit too neat and tidy, and what are the tail risks around there? And I think there's one tail risk that people are talking about a lot at the moment, and that's this kind of higher for longer, sticky inflation path. I think that's well and truly out there at the moment and somewhat discounted into markets. I think there's another point which Jamie Dimon I think is getting to here, that the recession call has become quite unfashionable. And for good reason. Everyone had that view last year, and it didn't show up in the data. So fair enough on that front. But if we were going to wind the clock forward to 1 year's time and there was a recession, then I think people would say, well, wasn't that obvious, because we just had the biggest tightening cycle, the quickest tightening cycle in a generation. Usually these things end in recession. So it's about the risks around that profile. I'm not calling for a recession. But I don't think the market's really paying attention to that. And as a fixed income investor, which is a hedge against recession ultimately, when that hedge is cheap, I think it's something that you should be looking at.
Fair enough. Deanna, signal or noise?
I'll say noise for this one. I mean, yes, there are merits in that argument, and I guess, yes, there are probabilities that you need to assess when you're making your decisions around your portfolio. You need to take that into account, that we could be in an environment where we go into recession, potentially lower growth, but stagflation, where you have high inflation, I'm thinking more inflation around 4 or 5%. We're just not really there anymore. I mean, inflation's just over 3% in all the major advanced economies, actually below 3% in places like Canada and the Eurozone. So I don't think that we have gotten to the environment where inflation is going to be stuck at 4%, because the forward-looking signals of inflation are still that we should get some further falls. Yeah, no, absolutely.
Lukasz, where do you fall on this?
Yeah, similarly, I think it's noise. I mean, I think you always have to sort of, examine all cases, and that would probably be our lowest case scenario in terms of that outcome. But it's obviously possible, right? So at the same time, we're seeing obviously inflation generally fall. There are pockets of stickiness, absolutely, no denying that. But the overall trend is continuing to go down.
All right, panel. So, given the recent moves in markets, your own team's forecast, everything we've discussed today, how are you investing client cash for the next 12 months? And Lukasz, I might start that with you.
So look, overall, from an asset allocation perspective, we're long risk. So we would say we're sort of cautiously optimistic.
Sure.
And within that, we've been, long the US equity market, but also looking at opportunities in that sort of mid-cap part of the market as well, because primarily driven by strong valuations and earnings support there as well. So long risk in terms of the fixed income market, probably a little bit more cautious, slight position in duration. And then within credit markets, again, probably looking at very much looking at the quality end. So lower exposure to cyclicals, higher exposure to financials within that part of the market. So overall, I'll say more on the pro risk side, and that's probably looking over the next sort of 6 to 12 months.
Got it. Thank you, Lukasz. Tom, within the bond funds that you manage, how are you allocated?
Yeah, well, our key message, I guess, is that the global rate cycle's turned and interest rates are coming lower. So we generally want to be long duration, which means that we've got strategies on which benefit from when interest rates come lower. I've talked about the kind of global theme. I think Australia does fit into this. The kind of way we're framing it here is that 3 is the magic number. So, we think we can achieve 3% inflation or below this year. We think the RBA's heading to somewhere like a 3% cash rate. And for the front end of the yield curve, so something like a 3-year yield, that can easily go to 3% in advance. So that's kind of where we're thinking of things in Australia, long duration, preference for the front end of the curve. And then New Zealand is one which we really like, because this is a central bank that tightened really hard, really early, and you're starting to see the negative growth impacts come through really strongly. So there could be an unwind that's more than what the market's pricing in. Europe and the UK, I think, are really interesting as well at the moment, because there, I think you actually might see an undershoot of inflation in the next few months. So you might actually see inflation below central banks' targets, which I think would be a surprise to most people.
Okay. Tom, thank you very much. Deanna, I know the last time, a couple of times we've asked this question to you, I know you've said that the teams are invested neutrally. Is that still the case? And I guess, just given what's happened in markets over the last month, do you feel a need to change?
Well, actually, we're probably a bit more positioned, similar to what Lukasz is saying, a bit more pro-risk now, lowered our cash allocation and more exposure to global equities, and a bit of underweight in Australia, and pretty neutral on fixed income.
Okay, perfect. On that note, a big thank you to Lukasz de Pourbaix of Fidelity International, to Tom Nash of UBS Asset Management, and of course to Mousina from AMP. As always, thank you very much. Before we go, I thought I'd share something fun because I was recently lucky enough to be a guest at the JP Morgan International Media Summit in London. And there was a slide that was put up on the screen that got a few chuckles in the room, so I thought you might enjoy seeing it as well. What you are now looking at is the last 5 chair people of the Federal Reserve. And it turns out you can match, roughly, their 10 years peak rate to their height. So you've got their Paul Volcker on the far left, 6'8", so a giant, but he also had 20% interest rates. Janet Yellen, on the other hand, is the smallest of the 5 at 5 foot, and she had rates at near zero for most of her tenure. And Jerome Powell is now overseeing an economy with a Fed funds rate that is roughly the same or similar to Ben Bernanke's peak Fed funds rate, and they have a similar height. So we're not saying correlation equals causation, but you can't deny there is one weirdly accurate correlation occurring here. And on that note, thanks for watching. Signal or Noise is back in 2 weeks with the Commodities Show. But if you can't wait until then, you can watch past episodes on YouTube, listen to our podcast, and visit the Livewire website as well, where you can access the wire that comes along with the show. Thanks for watching. We'll see you next time.